What is the difference between an index tracking unit trust fund, sometimes called mutual fund, versus an exchange traded fund? Now, both of these, the unit trust index tracker and an exchange traded fund, are both index trackers, these fantastic passive investment products, which we've been speaking about and where you really now know how juicy these are. So these are passive products as opposed to actively managed investments, where you have additional and higher costs as a result of having to have people involved in making those investment decisions. And so there are other posts about why I love passive investment products rather than actively managed. So I won't go into detail about that now. But now that you've got to say, okay, I love passive investment products, now how do you select between going for a unit trust index tracker versus an exchange traded fund for your investing? So now, if you think about a set of bananas, you've decided you want to get bananas. You've got a choice of how you can buy your bananas. There's still bananas. You could go to a supermarket where they have bought those bananas from the sort of wholesale side, and you go via that supermarket and you buy your bundle of bananas pre-packaged for you via the supermarket. Or you could go directly to the fresh food market where the farmer is at that counter, at the stall at that market, and you buy it directly via the farmer at the actual market. Now, this is a little bit around the difference between a unit trust index tracker versus an exchange traded fund. Both of them, the underlying investments, the underlying product that you're buying is exactly the same. It's bananas. So let's say, for example, you've decided that your core index tracker is going to be the FTSE 100 in London, if you're in the UK, maybe in South Africa, the JSE, the Johannesburg Stock Exchange Top 40, maybe it's an S&P 500 because you're wanting to cover the US market. Those are your bananas. That's the core investment. So now you can either get it as a unit trust or an exchange traded fund, both low cost. Now, in both cases, the fund house, that's the bunch that actually has the computer that goes and buys and sells those shares, puts them into this fund, which you can then get a slice of to have a bit of each of those companies in that index tracker. In the case of an exchange traded fund, that fund house slices up that basket of shares that they've now put, that index tracker fund, and they take those slices and they sell it to you back via the stock exchange. So exchange traded funds are bought and sold on the stock exchange. Really important distinction. So if you've got an online broker, you will make a trade, you'll put in your buy for that exchange traded fund, and that broker then goes to the stock market and buys that slice, that exchange traded fund for you to put it into your portfolio. Now, if you choose to get a unit trust fund, again via your online broker, they instead go to the fund house. And in this case, that fund house has, again, put all those bananas, those shares into that basket. They're going to sell you a slice of that basket. But in this case, the trade happens at the fund house. So your online broker goes to that fund house and gets you the slice directly from them. So why is this distinction really important? Because the difference is your upfront costs. Now, with exchange traded funds, because you're buying and selling on the stock market, you will typically have a trade cost, which is the cost of buying and selling on the stock exchange. And this can range from $7 to $9 in the US, £9 to £12, 50, 14 pounds per buy and sell in the UK, about 150 Rand in South Africa. There is an upfront trading cost because it's being bought on the stock market. Typically with online brokers, you don't have that same cost with a unit trust fund. You are able to buy at what's called no upfront load or no trading costs. And it's really important that you ensure if you're buying a unit trust index tracker, there are no costs. So upfront, it is cheaper to buy your unit trust. However, ongoing fees, typically unit trusts tend to have lower ongoing annual charges. These are the management charges. Now remember, index trackers by its very nature, both passive, have much lower ongoing charges than actively managed funds, and that's why we love them so much. But between a unit trust and an exchange traded fund index tracker, ETFs, as they're called, typically have lower ongoing charges. So this impacts you on the longer term. So what is my rule of thumb? I invest in both unit trust index trackers and exchange traded funds. Why? If I'm investing larger lump sums and typically a larger ongoing monthly amount or larger lump sums, and when I'm saying larger, this would be typically larger than £1,500, $1,500 per transaction, per investment. So we're talking about 15,000 Rand. I prefer to go the index tracker route because that upfront trade cost, that $7, that £12, that 150 Rand, must be well below my 1% cost. I want my total accumulation cost of buying that fund plus the ongoing cost to be well below 1%. So in bigger chunks, that cost represents a much smaller percentage. Now, if you're setting up your regular investment and you're investing maybe $50 or £50 or 300 Rand a month, that upfront cost, that trade cost of your index tracker per trade is going to represent a high percentage of that cost. So in those cases, I prefer to use an index tracker in a unit trust form because it has those no upfront costs. And so it's all about keeping those costs down. And I'm prepared to accept slightly higher ongoing costs because I haven't taken a big chunk of my money out in terms of getting into that investment. So that is the key distinction. So typically, if your regular investing is going to be below that £1,000 to £1,500 or US dollar or 15,000 Rand per investment, you're going to be investing through an index tracker in a unit trust form. And if it's bigger than that, in an exchange traded fund, and including any lump sums bigger than those amounts, you would want the exchange traded fund version of that tracker. Now, there's one caveat for that. For those of you who are in South Africa, the ETFSA platform, it's really combined the best of both worlds. It let you buy exchange traded funds, but with the low cost and no cost upfront convenience of a unit trust fund. So in South Africa, you can get the best of both worlds from that platform. But elsewhere, just know that is the difference between a unit trust versus an exchange traded fund index tracker and when you're going to use each. They're both bananas, but they have different cost profiles and how you buy them. So get investing, get tracking, get these passive investments working really hard for you. And if you're watching this video anywhere other than at thewealthchef.com, pop on over there. There's a lot of other resources and articles for you to really get savvy about your money and get it working hard for you. And I'd love to know any questions you've still got on the difference between exchange traded fund, unit trust, and unit trusts in terms of your index tracking, and what your experience has been in getting started, getting this asset class really working hard for you.